Chapter 5, Problem 4. This is exercise 511 in your text. They give us some facts here about this company called Rainey Enterprises. Let's make sure we get them all. They loaned $20,000 to another company, small company, for 1 year at 6%. They loaned the money on June 1st. So the first thing you need to see is that this loan covers more than 1 year. In the first year, they have June, July, August, September, October, November, and December. That's 7 months. In the second part, they have January, February, March, April, and May. That's 5 months. So the interest is going to be split up over a 2-year period. So let's take care of the loan first. So we loaned the money to this company. So we made the loan, so our cash went out. And our asset that went up was a note receivable. We just traded one asset, cash, for another asset, notes receivable. If we were doing a statement of cash flows, that would be an investment activity. Now, on 12/31, we have 7 months of interest. I need to remind you, and I think we talked about this in class, the interest formula is always the same. Interest, the amount of money you get or pay, is equal to the principal, the amount of money you borrow or lend, times the rate, the percent that you agree to either pay or receive, times time, and that's for parts of a year. So all you need to do is just apply that and you'll be fine. So we're looking for I, we're looking for the interest. So for the entry for the first part, the adjusting entry right here, that would be the interest for that is equal to the principal, the amount of money we lent, $20,000, times the interest rate we agreed on, 6%, that's 0.06, times time in parts of a year, 7/12. And when you work that out, and I'm not doing it in my head, I have it on my cheat sheet, that comes to $700. So at the end of the first year, we're going to recognize $700 of interest receivable, and that's a form of revenue, that's a form of income. So that would go under equity, that would be the retained earnings, that would be the revenue part of retained earnings. Okay, so the net income based on that would just be $700, revenue minus expense, $700. Now, at the end, two things are going to happen. We're going to collect 5 months more interest, and we're going to get our money back. It's a loan, after all, not a gift. So let's take a look at the interest first. We'll do the same thing. We have 20,000 times 6% times 5/12. And when you work that out, that comes to $500. So that's the interest for the second half, the second part of the loan that goes into the new year. So let's recognize that. We got $500 interest receivable, and that's revenue. And that will be net income if we were doing an income statement. We're not, because there are other expenses we're ignoring, but that would be income. Now we're also going to get our money back. This is a loan, it's not a gift. So we're going to get our $20,000 back. So this is going to flop. And this interest receivable we're going to collect, because we're collecting the loan. So we're going to collect this $1,200. We're going to collect this $20,000, and we're going to collect $21,200 in cash. Now, if we were doing a statement of cash flows, and we are not, but if we were, this one up here would be an outflow because we let the cash go out. This would be a $20,000 inflow from an investing activity because we lent the money as an investment. But by rule, the interest is always an operating activity. So this was basically just an opportunity for you to practice the interest formula and make sure that you always break it down for parts of a year. And I do it myself. I count on my fingers, and you couldn't see it, but when I was writing down January, etc., or June, July, August, September, October, November, December, I'm sitting here counting on my fingers.